In this video, I'll be talking about Intel, ticker symbol INTC, with a dividend yield of 2.7. They're a semiconductor chip maker. They recently had a big drop in their stock price, mainly because they had some production delays. I'll kind of be going through why I still think they're a really good value play. Intel is trading below $50 now with a PE ratio about 9. So first I'll do a breakdown of the business segments they're in and their financials, and then I'll be looking at the competition in the path ahead. So Intel breaks their business down in two segments, PC-centric business and data-centric business. The PC-centric business pretty much includes notebooks, desktops, stuff like that. The data center business is kind of more complex, but that includes like server, storage, and other things which I'll probably dive into. Intel management kind of breaks those two segments apart, mainly because they had a goal of pivoting it away from the PC-centric business, mainly because it's kind of on a decline. I don't think it's going to be growing that much. And as you can see here on this chart, they've achieved their goal of diversifying the business since 2018. Their data-centric business makes up more than half of their business, whereas it's continuously growing to be more heavy towards the data-centric business, being able to diversify away from the personal computing space. In this slide kind of shows why they wanted to make that pivot. I think they wanted to be in growing markets versus just defending the one they're dominant in. And I think this makes more sense. You can kind of see some of the things that are in the data-centric division. So anything that has to do with AI, 5G, stuff like that, that's all in the data-centric stuff. And here it kind of shows you what their data-centric business is composed of. The first one, the main one being server stuff, so mainly cloud stuff. Then they have the IoT division. Then they have Mobileye, which is a autonomous driving company that they've bought. Then they have storage solutions, and then they have FPGA solutions. And as you can see, they made the right bet here. The data-centric business is growing a lot faster than the PC-centric, even though they're both kind of growing, but still don't want to put all your eggs in one basket. So it kind of makes good sense to have this strategy. And you can even see this latest quarters to see the strategy makes a lot more sense. So even though we had a run for everybody working from home and stuff, so that kind of helped the PC-centric business grow at 7% year over year, their data center business grew 34%. So basically the demand for cloud and all this other stuff that kind of is needed now, it's growing faster than the PC-centric business. And if you look at microtrends.com, you can kind of see the revenue and the net income of Intel's been going up pretty steadily, as well as their free cash flow per share. And I mean, these last quarters have been pretty good. They usually kind of use this free cash flow to reinvest in the business acquisitions. They buy a lot of shares back, and they also pay a dividend. And if you look at their cash flow, you can kind of see what I'm talking about. Mainly their dividend's pretty safe. It's way less than their free cash flow, and the rest they kind of, if they have some money left, they kind of just buy back shares. And looking at their income statement, you can kind of see how much they're spending on R&D. So they seem to be spending $13 billion per year. That's quite a lot. That's more than some competitors even make in revenue. So their business pretty much allows them to invest that much into the business to keep it growing, plus have all the extra cash to pay dividends and buy back shares. Or if they didn't want to buy back shares, they can divert that to somewhere else, make an acquisition. And in my opinion, the acquisitions they have made seem to be pretty good acquisitions. Kind of going towards the data-centric business, kind of making sure they can keep expanding their business. And Intel's not that scared of making pretty big acquisitions. Like in 2017, they bought Mobileye for $15 billion. Mobileye is kind of a autonomous driving company. They used to work with Tesla before, but now they're kind of selling the solution to a lot of the old OEMs. And in 2019, they almost had $1 billion in revenue. So I think it's a pretty good deal that pays off in the long run, and that will secure Intel's part of the game going forward in that section as well. And acquisitions like that kind of show a long-term strategy that Intel has of growing their other divisions away from just the PC. And they can keep affording this strategy because, I mean, this was $15 billion when their cash flow kind of per year on average is like $10 billion. So they don't have to take on a lot of debt, and you can easily afford to reinvest in the business to keep trying to grow it. If they don't find opportunities, they just buy back shares. But if they find a good one, I don't think they would hesitate on buying one. And you could look at Intel's ROIC, which is return on invested capital, see how well they are doing as far as investing that capital that they have, and they have a 20% ROIC. You can kind of look at their peers and kind of see they're kind of in the ballpark as far as what they're getting. The market's still trading them at a pretty low multiple. Right now they have a single digit PE with a double digit ROIC, which I rarely ever see. I mean, I think it's mainly because they're caught up in the segment that's some of the players are growing faster than them, so the market kind of leans towards them a lot more than Intel. But I mean, Intel's doing fine, so they should be trading at a higher multiple. It's just that given their peer group, I think the market kind of looks down upon them. Basically, if you wrapped Intel's like financial numbers and growth numbers into another segment like retail or something else, I think the market would kind of give them a higher multiple. But I think it's just because they think it's kind of a binary choice in the segment, they kind of get a really low multiple at the moment. And to kind of highlight how binary the market's kind of looking at this, for Intel, their second quarter for 2020, they had a 20% year-over-year revenue growth, and AMD had a 26 year-over-year revenue growth. However, Intel's PE ratio is 9, while as AMD's is 158. And in my opinion, I really don't see this market as binary as Wall Street's kind of looking at it right now. I think we're kind of going to more specialized processors that are optimized for certain applications. So even if AMD takes over the desktop market with higher cores per price, I mean, Intel can be taking over other things like autonomous cars, and same with AMD going into games. And like, there's certain applications where both of them can both grow at the same time. I just think that the market's kind of looking at very binary. And to kind of show how binary the market's kind of looking at this Intel versus AMD situation, I kind of pulled graphs as far as like usage between the different segments and how big they are for Intel as far as revenue. So the desktop's 11 billion and laptops 20 billion and servers 20 billion. If you looked at the overall graph, I think kind of like the desktops, AMD's making ground there. The server, Intel's pretty dominant, and AMD's also making ground on the laptop. But the desktop's the slowest growing segment, and I think you can kind of see here that if you go back, AMD was beating Intel for a while, then Intel kind of came back, and I think it's a back and forth that continuously happens between them two. And I think in the long term, the server segment will be the biggest, and I think both of them will grow, mainly because both will probably focus on certain workloads and optimize their chips to do that work. So they'll probably both do fine here and kind of talking about the thing that made the stock tank, which was a 7 nanometer delay, even though Intel reported a pretty good quarter. And that 7 nanometer is kind of competing with AMD's, which really is Taiwan Semiconductor Company's 5 nanometer. But I think kind of Intel kind of knows that you don't win it all with the smallest nanometer. I think AMD has had that advantage for a while now because they've been on 7 nanometer I think since last year, and Intel's barely rolling out 10 nanometer, which kind of competes with them on that aspect. But it's not, I mean, as you could see, like the servers and stuff like that's not the end all be all of this segment. Either way, I do see the 7 nanometer delay being an execution error on Intel's part, which they do have to start addressing as far as being able to make continuous progress as far as making better processors, but I don't think it's as drastic as the street is looking at it. And I also don't see it as an end all be all, mainly because Intel spends more on R&D than AMD makes in revenue. So I think they pretty much have more optimizations than just transistor size. And for Intel stock price, I kind of see it growing with their revenues, which I think the last 2 quarters have been really good. I think 20+% year over year. And then I think in the long term, the market will kind of correct itself as far as the multiple that it's trading at, and kind of see that that market's not that binary, or the delay is not as drastic as they kind of see it. And there's also some upside as far as other segments they're investing in, growing at a higher rate, and then that kind of giving them a higher multiple as well. So there's a lot of things that could potentially happen on the upside. And I think the market's kind of pricing in worst case scenario and kind of avoiding the fact that they had 2 really good quarters. So I think your downside is pretty well protected, and you pretty much have really good upside. So I think it's a pretty good long-term play, and you get a dividend. If you'd like to see more videos like this, make sure to subscribe, and if you have any questions, leave them in the comment. See ya!